Meanwhile, China growth data for the fourth quarter missing market estimates, and that's weighing on Chinese stocks. For the full year, the nation's economy grew at 5.2% rate last year, hitting the government's official growth target. Joining us now is Brendan Ahern, Krane Shares Chief Investment Officer. Brendan, it's great to see you. So let me just get your take on this economic data from China that we got here. GDP expands 5.2% in Q4 and for the year. The Journal noted an interesting stat here that actually, if you look at the Chinese economy, expanded last year at the slowest annual rate since 1990. Just interested, Brendan, let me get your take on that data and how you see the Chinese economy evolving in 2024.
Yeah, thanks for the opportunity, Josh. Yeah, the numbers were good, not great, not bad. I mean, some of the estimates in terms of Q4 GDP were a little light for the year. To your point, they met. So it shows that China's economy is coming back incrementally after the post-zero COVID crisis, which has really weighed on consumption trends in China. But it is coming back. It's just coming back slowly, incrementally, with the government kind of giving little nudges of support, but no policy bazooka, no free checks in the mail, no modern monetary theory. And that's left investors a little bit underwhelmed. They'd like to see a little more support.
Well, it's interesting to me, Brendan, you sound a little bit more positive on the China story than I had anticipated. And I'm curious, what do you think investors are missing when they're talking about timing the bottom in China? What upside are we potentially missing here?
Yeah, it's a great point. I think it's been really hard to catch a little bit of what's been a falling knife, as well as the U.S. equities have really been the only game in town in terms of global equities, in terms of U.S. stocks have vastly outperformed. So we're recommending investors volatility adjust to position, potentially dollar cost average, maybe using overlay strategies such as options or structured products that can provide some level of principal protection or buffering, because we know this market is going to come back, and when it comes back, it tends to come back in a very dramatic fashion. It just market timing has been really, really difficult.
Yeah, nowhere to go but up, it sounds like. I'm curious, in the ETF space, would you say that the globally diversified ETF is still the move for investors, given that dynamic that you mentioned, where U.S.-centric stocks, the S&P 500, is performing so well compared to the MSCI?
Yeah, I mean, listen, over the last 14 years, the S&P 500 is up well over 800%. Non-U.S. equities, as measured by MSCI's All-Country World ex-U.S., is not even up 1/3. So I think ultimately investors need to be aware that the next decade might not look like the last decade. And we just feel like 14 years, 56 times of opening up that quarterly statement, your non-U.S. equities underperform again. People are just throwing in the towel. And that reminds me a lot of what people felt about U.S. equities in March of 2009.
And Brendan, I'm interested, broadly speaking, when you look at these U.S.-listed Chinese names, Brendan, does valuation look compelling to you, or no, you think analysts are going to be, trimming their earnings estimates?
I think, self-serving and highly biased, we manage KWEB, the China Internet ETF, one of the largest China ETFs. Listen, with Amazon's market cap, you can buy all 31 companies in KWEB and still have $400 billion in cash left over. And that's despite Amazon having less revenue, cash flow, net income, EPS. So we think it's reached such an extreme point. It's laughable, right? The question is, what's the catalyst to get people back in? And I think potentially if we see the Fed cut, you might see the dollar start to roll over, which makes U.S. stocks a little bit less appealing to some of these foreign investors.
You mentioned KWEB, and I'm curious, you've got Alibaba in there, JD.com, some of the names that we were talking about earlier in our show that are struggling today off of that China economic data. What is the catalyst for upside on those names that's going to drive that ETF forward?
Yeah, I mean, I think there's a point where these companies themselves are the only believers in the stock, maybe besides myself. They're buying back stock in a very significant way. Alibaba spent billions of dollars buying back stock last year. Tencent files for their buyback every day. Meituan just started buying back the first time ever. So I think one is, at some point, fundamentals do matter, and we see other investors come back in. At the same time, there are some structural issues that we reported about today that where Hong Kong is a big kind of structured product market that when the indexes hit big round numbers, a lot of these products have to be unwound. It's forced redemptions, and in absence of buyers, that's causing the market to just to fall. So we think potentially the regulator, the exchange, should intervene. Something we actually saw take place in South Korea in November, where they actually banned short selling. So we think there's the potential for some sort of intervention to try to keep this market from kind of cascading downward, something that we've seen over the last 2 weeks.
Well, and that's exactly what I'm curious about when you look at the property market. How is China going to avoid sort of a Lehman Brothers moment? I think back to Country Garden missing their bond payment back in August. What do you think needs to be done based on the conversations you've had on the ground in China for the country to avoid that?
Yeah, and being in China in December, that was one of my questions is this China's Lehman moment? And the view is in China that it's widely recognized that the U.S. Federal Reserve allowing Lehman to go bankrupt is the greatest error ever by a central banker because it created a financial crisis. And why would the Chinese government, Chinese financial regulators allow one of these distressed players create an economic crisis? So it's receiving a lot of attention. I think it's important to recognize the December property sales was very disappointing. They just did a new trillion RMB, several $100 billion US, to support the real estate sector. They just announced that last week. So we haven't seen the effect of that. So we're going to see a lot more policy support on real estate based on a very, very bad number in December as reported overnight.
And Brendan, I want to get you out of here on this. We talked about the economy and valuation, Brendan, but we didn't touch on geopolitics, and I am interested this tension between Washington and Beijing, Brendan. It's running hot. I mean, honestly, it seems like the one thing that maybe Republicans and Democrats actually agree on is their concern about China. How do you think that shapes and plays into investor sentiment?
Well, I think it certainly kept a lot of investors on the sidelines, and the main worry, Josh, if you're worried about China invading Taiwan or U.S.-China geopolitical, the stocks you should be worried about are the largest companies in the U.S. Apple does mid-teens revenue in China. Tesla, 25% of their revenues in China. ExxonMobil, 12%. Nike, Starbucks, Boeing. These economies are highly intertwined, and I think we're reaching a level where some of the political rhetoric out of Washington, D.C. threatens U.S. corporate interests in China, where they've done very, very well. I think the Biden administration is trying to tone down the rhetoric. Obviously, they don't control Congress.
Brendan, really appreciate you joining us for your insights on China. That was Brendan Ahern. Thank you so much.